welcome. You're watching The Money Show, and I have with me Gautam Kalia, Head Super Investor, Mirae Sharekhan with me today. Gautam, hi, good evening. Welcome to the show. And let's begin with our queries. I think I have Raghu from Chennai who wants to ask his question. Raghu, hi, good evening.
Good evening, ma'am. Thank you very much. And I am the regular viewer of Money Show. I benefited a lot from your show, actually.
Really? Thank you so much. Thank you so much. It really helps us in, deciding the programming for our viewers. So thank you so much for this motivation.
Yeah. Thanks.
But Raghu, I want...
ma'am.
I want to ask you this question. So you want to move this amount from your PPF to a balance advantage fund. What is the time duration or investment duration that you're looking for?
Because basically, what I analyzed myself, I see recent equity fund I analyzed and balance advantage fund I analyzed myself. Almost 25 years I'm putting on PPF account. When I analyzed both the return, I lost the heavy money, almost 1.25 crores I lost by putting in the money into PPF. If I same money, if I have invested in mutual fund, by seeing your show also, I could have benefited.
Raghu, you are comparing oranges and apples, but you are comparing oranges and apples. You can't be comparing an equity mutual fund with a PPF. It is a fixed income instrument. So you might want to compare it with a fixed deposit. So the comparison goes wrong, but then I really understand your question. So see, a balance advantage category is a hybrid category. You get equity as well as debt exposure in it. I understand that you want to have an SWP after 1 year of your investment. Is that right?
Yes, madam.
Okay.
I wanted to only 5%. That's all, not 9%.
Sure. What is the total amount of investment?
63 lakhs.
63 lakhs.
Yeah,
got
it is maturing in the current year. April, it is maturing 63 lakhs. Because I am facing problem in PPF account, once in a year only I can withdraw. And they are putting limit also, amount also. I am facing problem.
Exactly. No. A feature like SWP, you really can't have it on a PPF. But having said that, you will need 5% of this amount for how long?
Maybe, ma'am, over a period of time, actually maybe 1 or 2 years.
1 or 2 years, that's it?
Need basis, madam.
Need based.
Maybe consistent.
So why a balance advantage fund? Advantage fund? Can we suggest you a pure equity fund? Will that be okay, or you are risk averse?
Yeah, not an issue. I'm aggressive investor, not an issue at all. That's your advice, not an issue.
But your investment time horizon has to be 5 years and plus, okay?
Yeah, I am willing to have 10 years. This money I will not take more than 10 years also. This money, the capital I will not disturb at all, actually. I will keep for 10 years also, not an issue for me.
Very nice. All right. Thank you so much for giving me all the details. I'll connect with our financial planner. Gautam, you have all your questions answered now. What's the plan for him?
Thank you. Raghu, just one quick question. Are you retired or close to retirement, or is there a while to go?
Yes, ma'am. Yes, sir. I am actually a senior citizen, actually.
Okay. All right. So
say you are an aggressive investor, and still you say you're an aggressive investor. That's a wow.
Yeah, I am aggressive investor. Not an issue at all.
Lovely. Gautam.
Yes. So Raghu, what I'd like to tell you is that because you're moving money from PPF, which is like a pure debt investment, into something which is a combination of equity and debt, like a balance fund. Equity has about 70% exposure and debt has about 30. That's typically the long-term average of equity and debt in balance advantage products. What I would suggest is that you can make this transfer, but keep the investment for 3 to 5 years at the very least. And I think a systematic withdrawal plan of about 5% a year after the first year is okay. There is no problem. You can look at the following funds like HDFC Balance Advantage Fund or ICICI Prudential Balance Advantage Fund. Maybe you can split between these two. When you do make this investment, one of the things that I would like to add is that you could even change the rate of your systematic withdrawal plan over time depending on how the market performs. So if the fund is delivering as per your expected returns, or it's delivering higher than that, you can actually start withdrawing more. And if it delivers less than your expected return because of, let's say, market corrections, then you can reduce the percentage that you withdraw, stop the SWP altogether to give it time for for the value to go back up. So these are some tactics of a dynamic SWP that you could deploy. Otherwise, if you're looking for something that is pure equity, you'll have to keep in mind that you're shifting your asset allocation entirely from debt into pure equity. So you'll just have to be careful there because of the increased volatility in the amount. We all look at the returns, but you have to keep in mind that there have been times in the Indian stock market where investors have not received even savings account returns over like 6-year periods. So that's something that you have to keep in mind, that those periods can also come again. So as long as you're comfortable with seeing your principal deteriorate even by 10-20%, then I could suggest that look at a flexi cap fund, like a Kotak flexi cap fund, to put in that entire money, or build a portfolio of 4 or 5 funds which is purely equity. But for now, I would advise, given your age, I would say 70-30 is also aggressive enough, and maybe stick to balanced advantage funds.
All right, so Raghu, there's HDFC Balance Advantage, ICICI Pru Balance Advantage. That's a recommendation coming for you. And if at all pure equity, then maybe a fund like Kotak Flexi Cap. But then you also know the pros and cons, of being in equity. Although you are aggressive, but then Gautam suggested you a slightly conservative strategy just to protect your money. Is there anything else you want to ask, Gautam?
No, ma'am. Thanks a lot. Excellent answer.
Thank you.
Lovely show. Lovely show.
Thank you so
Thank
much.
you.
Thanks. All right, let's move on. And Gautam, my next question is from Kalyan, and he says that he's 40 years old, regularly watching the Money Show, and he has some funds investments done. And okay, so just started investing in mutual fund is what he's saying. And next 10 to 15 years, he plans to begin with a monthly SIP of 30,000 and aims to reach a target of 2 to 3 crores. And for that, he needs fund suggestion. And he also says that he can step up as much as required for his investment, for the goal that he wants to achieve, which is 2 to 3 crores.
Yes. So for Kalyan, what I'd like to say is that your duration is very good, because you're looking to do a SIP for 10 to 15 years. You're giving your portfolio time to compound, and that's really what helps create wealth over the long term. If you start at 30,000 rupees per month and your portfolio grows at 12% per annum, then you're looking at a corpus size of about 1.5 crores in the next 15 years. So if you are not satisfied with that, because you're looking at a target of 2 to 3 crores, you could step up the SIP amount by 6% every year, and then you would cross the 2 crore threshold. Alternatively, you could, instead of 30,000, start at 35,000 and then step it up by 10% a year. And again, in 15 years, you reach 3 crores. So these are the various calculations I thought I'll share with you, and you can decide what suits you as of now. In terms of the portfolio, what I'd suggest is I'll give you percentage allocation now, depending on the amount you're finally going to deploy. So you can put 30% in HDFC Large Cap Fund and 30% in ICICI Prudential Flexi Cap Fund. The remaining 40% you can split between Bandhan Core Equity Fund 15%, and you can put the remaining Nippon India Growth Fund and HSBC Small Cap, which totals to about 25%. So this is what your portfolio will look like. It's a 5-fund portfolio for you to start.
All right, all the best, Kalyan. But then let's move on to Dilip's question, Gautam. And he says that he has invested some part of his portfolio in Quant Mutual Fund, Quant Focused and Quant Flexi Cap, and 50,000 lump sum is what he's saying. Okay. And he is not sure if he should be holding on to these funds or should be making an exit. Okay, it's 50,000 each in these funds. And what's the future of these funds also? Even I would like to know that, Gautam.
So, as a house, we are not extremely bullish on this. And what I would suggest is, because you've got these two funds, they belong to one AMC, I would like to suggest alternatives. So you could look at moving part of this. So it's not that these funds you should remove altogether, but you should look at moving part of this from, let's say, Quant Flexi Cap to something like an ICICI Prudential Blue Chip Fund. So you have a large cap allocation there. So maybe move 30,000 of that 50,000, and the Quant Focus Fund, because you've got just the Flexi Cap and the Focus, So move part of the quant focus fund also from an allocation perspective, move 15 lakhs to Bandhan Core Equity, 15,000 to Bandhan Core Equity and 20,000 to HSBC Midcap Fund. So you can make these changes. That way you have again a 5-fund portfolio diversified across asset management companies, and you don't have all your eggs in just these one basket of these two schemes. Because typically we like to reduce concentration risk when we look at creating portfolios for clients.
All right, I think that will be time up on the show. Thank you so much, Gautam, for being on the show and helping our viewers with their portfolio queries today. And for our viewers, I'm going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.